Good morning, everyone. Thank you for joining this webinar. So the topic what we are going to discuss is that when the market goes nowhere, how we should make our investments to work for the benefit of us. So before jumping into the strategies, let's go through the macro aspect on how the Indian market outlook is currently right now, right? So when we see the macroeconomic environment, is the voice is audible? You can just confirm in chat, by the way. So first, when we look through the macroeconomic environment of our country, the let's see first Nifty 50 benchmark. So last year, when we see Nifty 50 was relatively flat, by the way, it is kind of trading around 24,000 to 25,000. In that range only, it was fully traveling. So that's a sign of market consolidation. So it's due to some good indecision, so lack of momentum. Even we can't see any good direction in the market. But remember, this sideways market are very common, by the way. If we look back post 2008 crash, so typically when you see from 2010 to 2014, that period when Nifty is trading around 6,000 in that range, for around like 4 to 5 years, it's fully in the flat zone only, by the way. So similarly, same thing happened before the big bull we saw. Pre to that, around 2018 to 2020, was a dull consolidation period before the next leg which started. By the way, so flat market may seem frustrating, but they often necessary for a next rhythm the market should upcome. So now let's talk about inflation because your investment choices only matters in real terms. So it's very important. We should make our decision after taking out all the inflation stuff, what is related to that. So as of July 2025, India's retail inflation, which dropped to a kind of very low, which is around 1.55%, which is mainly kind of driven due to the kind of food prices has been reduced like pulses and so this is below the RBI's that tolerance band in the range of 2 to 6%, which is really a good thing for kind of a developing country like India. So with this inflation cooling down, the next question what we get is what RBI is doing with the interest rate. So now let's break it down. We know that in June, the RBI made a bold move in cutting the repo rate by 50 basis point. So from 6%, it has been made to 5.5%. So it's really a good move, by the way. But the same thing in August MPC meeting, they were in a neutral stance because we all know that the Trump tariff issue, which started at 25%, 50%, and so. So to keep everything in a good condition, the RBI just kept the neutral stand. So the current scenario is low inflation plus a steady rate. This environment favors long-term investment like equities, by the way, right? So especially if you are deploying SIPs, returns likely to stay ahead of inflation. But now let's understand why the market goes sideways and how investors react. We need to understand that when valuation outpaces earnings, market passes. So we all know this Q1 earnings is not that good, but the valuations has been very much an upper hand than the earnings. So maybe in Q2, this can be made to a good symmetrical line. So to catch up with the fundamental, the market needs to consolidate. When we see overseas uncertainties, this interest rate shift and some sector specific consolidation, like what we see in pharma and others things which are affected due to this tariff and so this all trigger the range bound market, right? So during such time, we often see investors' behavior like impatience, hesitating to invest or attempt at market timing. But thankfully, this is not a natural phase, kind of, but even it's not a crisis, by the way. So in kind of a future, the revenue will catch up, even the policies will stabilize. We all know the recent GST changes what has taken place, which is a good thing. But due to this tariff, which has some negative effect, so both positive and negative, which is going hand in hand. So everything will be good, and the sentiment return will be also good. So what should you do when this index, which is not moving much? Step one, don't fixate on the index. Focus on your financial goal, not the market moment. Then use SIPs to your advantage. As a sideways market is when rupee cost averaging truly shines, by the way. Then keep your portfolio diversified. So in this consolidation phase, asset allocation and rebalancing becomes very important. So this macro setup, this flat equity, low inflation, stable rate makes it excellent time for goal-based investing and structured wealth creation. We'll all discuss about this topic, what I discussed right now, in a much deeper in the upcoming slides, by the way. So now let's shift the gear from the macro view to somewhat like very personal stuff like our financial goals. Most investors tend to ask what's the return? But the most powerful question is what's the purpose? Returns are the only meaningful when they are aligned with your actual actual purpose, what it's required. For example, a 12% return sounds amazing. But if you need only the money next 2 years for your child's education or like admission fees and so, and the money was stuck in equities, even the market downturn, something may happen. So that 12% is become meaningless because we should see on what kind of horizon, timeline your goal is being made up. So focus should be always be like goal first, returns later. This keeps us ground and prevent us from the chasing the latest stocks, funds, or thematic, which is trending right now. What we are seeing, by the way. So let's give you some example of what goal-based investing most familiarly we are seeing around the clients. So first is child education. A corpus is needed at a fixed time, and say down the line in next 10 years we need some kind of good corpus to take care of our admission in college and so. Then retirement planning, replacing a monthly salary for the next 25 to 30 years after your work life, then home purchase, so down payment which is required in this 5 to 7 years. Then the emergency buffer, like which is not glamorous, but it's really a stable thing which you should keep, by the way. So noticing something, each goal has a different time horizon and risk tolerance. You cannot treat a 2 years goal and a 20 years goal with the same investment approach. This brings us to a breach between the goals and strategy. So for a short term, you should have a more kind of more liquidable investment. For a medium term, you should have a good combination of equity and other asset classes. For a long term, you should have a more equity oriented with a long tenure SIPs. So this is why a goal acts like a compass. Instead of asking what's the best fund today, you ask which investment suits my goal horizon, and that's where the asset allocation becomes automatic and logical. So now let's link goal-based investing back to our main theme today. What do you do when the market goes nowhere? Market moves sideways all the time. This is the most when most investors panic, stop SIP or worse, pull out the money. But when your investments are tied to goals, you don't need to panic, by the way. For example, if you know your child's education goal is 12 years away, you don't need to care of Nifty stuck for the last 6 months and so. If your retirement is 20 years far away, today's stagnation looks like a small blip on a much larger journey. So goal-based investing builds emotional discipline. It shifts your mindset from short-term noise to a long-term clarity. This discipline is often the biggest differentiator between successful and unsuccessful investors. So now that we have seen the importance of goals, let's talk about the most practical tool to stay disciplined. That is systematic investment plan, SIPs, by the way. The biggest advantage of SIPs is a rupee cost averaging. When market goes up, your SIPs buy fewer units. When the market falls, the same SIP buys more units. Over the time, this average brings down your average cost per unit in an overall manner. So think like example, like you're buying egg today, which is cost around 6. Tomorrow it can be 5. The next day it can be 4.5. Next day it can be 7, but in average it can be around 6 when I keep on buying every day. So this is how the SIP works in the same way in the mutual funds also. This mechanism is especially powerful in sideways or volatile market because you keep accumulating at lower prices without even trying to time the market. Now let's address a common worry. What if the market doesn't move for years? Even in a flat or a range-bound market, SIPs have delivered more positive returns. For example, in a certain phases, like the Nifty 50 index itself looks stagnant, but SIP investors still made meaningful returns. Why? Because SIPs take advantage of those small dips and recoveries within the consolidation phase. While lump sum investors saw no growth, but SIP investors benefited from buying cheaper units regularly. So SIPs are like your automatic shock absorbers. They keep working quietly, even when the headline index looks like more flat. So now we can go some more deeper into compounding, by the way. We all know compounding works with time plus discipline. But here's an interesting part, even during stagnant phases, compounding is quietly at work. Imagine if you're investing 10,000 every month for 5 years during a flat market. At first, it feels boring. Nothing seems to be happening. But suddenly, when the market breaks out of consolidation, your accumulated units multiply in a very quick manner. This is why SIPs look slow in short term, but powerful in the long term. The real magic is that compounding doesn't need the market to be like always should be rising zone. It just needs you to stay invested and consistent. Let's take some other real case scenario. Around 2015 and 2017 Nifty phases, which is trading around some 7,000 or 8,000 level. During this time, the market was very largely consolidating. Nifty was moving in a tight range. For many lump sum investors, it was frustrating. Returns look so flat, by the way, right? But for those who continued SIPs during this period, they accumulated units at attractive prices. They didn't stop investing out of boredom. And then when the market broke out in 2017 and 18, their portfolio surged. This shows the sideways market are not wasted years. They are, in fact, the years where SIPs quietly sow the seed for a future wealth. It's like planting a seed in dry soil may not see growth for a while, but when the rain comes, the field turns green overnight. That's the thing. So most investors start their journey with equities, but wealth creation doesn't rely on only one asset class. True investing means going beyond equities. So gold, which acts as a hedge during inflation and global uncertainties like war, tariff, and so. Even fixed income, which brings stability and predictable cash flow, which is good asset class in the recent period, by the way. Also, foreign equities, which gives exposure to global growth, like China, US, and other emerging markets, also you can take into consideration. Then precious metals like silver, which has a good industrial use at the same time as a store of value. Each of these asset classes have differently behave during different market conditions. For example, when the equities are down, gold often does well. When the foreign markets rally, global equity funds benefits. So spreading your money across these ensures different asset classes ensures that you are not dependent on just one engine. We often think nothing is happening in these phases, but actually sideways market are the best time to rebalance your portfolio. Why? See, because during this sideways market only, relative performance between asset classes become more visible. See, equity may stuck in a range, but gold might have moved up, or fixed income might have given higher yields. So by rebalancing, you are doing two things automatically, by the way. So first, you are selling a bit of what has gone up and adding to what is undervalued or just lagging. This systematic adjustment ensures that when markets eventually trend again, your portfolio is positioned at the right balance. It's like turning a car engine kind of in a perfect way during the traffic and so. So diversification is not just about chasing returns, it's about ensuring smoother returns. Think of it like a cricket team. If you rely only on star batsmen like any new stars, but the match could go even either way. But if you have a good balanced team with a strong all-rounder, strong bowler, even a good fielders, sorry. So yeah, so having a good cricket teams makes a team to perform well. In the same way, having a good asset allocation makes your investment to perform well. So that's the thing. So in investing, diversification plays apart from this stuff, it even plays even good other roles also. Like it keeps you more calm, by the way. It keeps you more stable during most of the uncertain times also. So the key takeaway I want to say is that don't pull out all your eggs in one basket. Spread them smartly into different baskets to get some good risk adjusted returns. So an emergency fund is most underrated one. We all know it's part of financial planning. So when markets are uncertain, like we saw a lot of events like this war, tariff, even you can take COVID also. Without it, see, even investors are forced to sell their long-term investment at this worst possible times, usually at a loss. With it, you can handle life's shocks like something happened in a family or so. So having this emergency reserve is a very much important stuff in this current time. So how much is enough? A common thumb rule is to you should have around 3 to 6 months of your household expenses as your emergency fund. For a single person, 3 months may be sufficient, but for a family with the kids and so around 6 months or more is more safer. So you should keep something like your rent EMIs, groceries, utilities, insurance premiums. So basically all the expenses you cannot skip even in the tough times. So the real power of emergency fund is psychological. It keeps you calm during crisis. Instead of panic selling your equity investment when the market crashes, you rely more on a cushion of good cash flow, by the way, because you have emergency fund, by the way, right? This ensures your long-term investment stays intact and have a time to recover. In other words, emergency fund protect not just your expenses but also your discipline as an investor. So you can have that in a more liquid kind of fund. That's the thing. By the way. So most investors think reviewing their portfolio is only important when the markets are moving a lot, either up or down. But in reality, period of market stagnation are equally critical. See, when the market are flat, many investors get complacent or stop tracking or assume everything is fine. But that's when the silent risk builds up in the portfolio. See, over the time, even if market don't move much, different asset classes grow at different speeds. This is called something called allocation drift, by the way. Okay, so for example, equities may go not go, but suddenly you can see the gold would have gone up, so regular review helps you to spot this drift and bring your portfolio back to line with your goals. So when market consolidate or move sideways, it's actually a good time to rebalance your portfolio because valuations aren't extreme. See, you can shift excess allocation from one asset class to another with minimal stress, by the way. This disciplined rebalancing adds stability and sets up you up for a smoother compounding when the market eventually trends up again. So yeah, so finally, this periodic review helps you avoid which I call like portfolio neglect or something, a situation where investors forget why they brought certain funds and end up with a clustered or a kind of a cluttered portfolios, overlapping schemes or outdated investments. Just like a health checkup, a portfolio review keeps things clean, purposeful, with aligned with your long-term financial goals. So yeah, behavior wise, most common mistake in the flat market are like exiting so early or chasing the fads and so. So importance of long-term view is very important. Goal-based investing is very important. Make a consolidate, make markets may consolidate, but before big moves, so it's always required to be more disciplined and patient. So it's all on how we behave in this particular time zone. So most investors don't fail because of lack of money. They fail because of lack of structure. See, people say we are there, but without direction, they chase the next hot fund or panic when the market falls or simply procrastinate. But here's why our M2W program comes in Milestones to Wealth. It is designed to help investors convert their scattered savings into a meaningful wealth through discipline and guidance. manner, by the way. So the name itself tells you that the essence of milestones to wealth. Everyone has milestones: buying a house, child's education, retirement, or simply becoming financially independent. But milestones remain dreams unless they are connected to a structured wealth plan. So M2W act as a bridge. It translates your milestone into an actionable investment journey backed by a data-driven planning with a long-term, long-term goal-oriented plan. So the backbone for this M2W is goal mapping. We don't just ask how much do you want to invest. Instead, we ask what are your life goals, what do you need them for, how much you need the based on your cost of living. So we go through a lot of financial planning process before making a proper allotment for you. So this shift the conversation from the random investment to a more purpose-driven, goal-based investing. And once a goal are mapped, disciplines take over through regular reviews, SIP-based investing, risk alignment, and of course behavior management. See, because wealth creation is not about one-time decision, but about sticking to a disciplined path for decades. So let me share the small real life example. Suppose an investor has 5 lakhs today. Without a structure, it may sit in the bank, get deployed in a bit 10 pieces. After 5 to 10 years, it's still not a meaningful lump sum. But under M2W, we chart a path. 5 lakh is a seed nurtured by regular SIPs and reviewed periodically. Over 15 to 20 years, with the power of compounding, it can grow up to 1 crore or more. This isn't magic, it's a simple maths plus discipline. So the difference is that without structure, wealth leaks away. With M2W, wealth compounds with purpose. Okay. So you may ask, why can't investors do this on their own? Of course, anyone can, but see, just like fitness, everyone knows they should eat healthy and exercise. Yet gyms and trainers exist, right? Because people need accountability and expert guidance. So that's why we are here, by the way. Similarly, in investing, professionals bring three critical things: clarity. See, first, cutting through noise and keeping focus on goal is very important. So the second thing is behavioral aspect. Of course, like discipline, ensuring review, rebalance, and SIP continuation. Stopping, like behavioral support we provide, like stopping investors from panic selling in crisis, chasing fads and bubbles. This human layer of guidance is often the difference between average outcomes and extraordinary outcome. So the M2W program is more about not just returns, it's about giving structure to your dreams, discipline to your goals, and a confidence to your future. It ensures that no matter what market do, you're always moving steady towards your goal. And that's how our milestones work. Whether it's your child's education, retirement, or financial independence, we transform it into a good, meaningful purpose. So thank you for attending the webinar.